And welcome. Iqbal's right. It's probably a long time past due since we've got together. Much has gone on in the volatility space. Much has gone on here at CBOE. So we're pleased that everyone's able to join us today and hear a bit more about the progression of the product, some new products, some insight from Jamie and the rest of the group down at Group 1, who was very instrumental in the trading of VIX Futures. So my job today as Director of Business Development is to give an overview of what has taken place at the exchange, talk about some of this growth, and what we are seeing from the exchange side. In order to build a boat, one must not only have a level knowledge of shipbuilding, but you also have to be aware of the conditions in which you're sailing. Wind, tides, turbulence in the water. When you build a balanced portfolio, the same type of applications apply. You need to know what's out there, and that turbulence quite often manifests itself in the form of market volatility. So how do you trade that volatility? How do you capture volatility? How do you eliminate volatility? Well, it all comes back to us here at CBOE, more specifically CFE, the CBOE Futures Exchange. So let's talk a little bit about the progression of our product here. So 2004 saw the launch of CFE and VIX Futures. Now keep in mind that the VIX index itself had been around since 1993 and it was based off of the OEX at that time. Market participants recognizing that the SPX represented a more broader constituency of the overall market, and through our work with our research team, folks at Goldman Sachs, we altered the methodology, and in 2003 we applied it to the SPX. So now that the VIX itself captures the entire volatility surface as expressed by out-of-the-money calls and puts in the SPX options. So that was 2004. Trade at that time, it was lean. Here we have a new product that was quite niche to begin with, and aspects of the product that weren't the same as you would find in some of the other standardized futures contracts that you trade. So for us at the exchange, it was certainly a great experience in that we learned not only how to build, market, and present a product, but also how to build an exchange within the exchange. Things started taking off in 2006 with the introduction of VIX options, of which Jamie is the specialist for that product. Prior to that, most of the volume we saw coming through the futures was somewhat limited to over-the-counter variance trades using VIX futures to hedge their implied portfolio. So in essence, they're doing a realized volatility trade, OTC variance, hedging it with implied volatility in the form of VIX futures, and had the two converge. But with the introduction of VIX options in 2006, it opened the futures up to a whole new client set in the form of market makers here on the floor at CBOE, also off floor, of course. So now the market makers who use VIX futures to price their options turn to VIX futures as their hedge. So we started to see a little more volume creep into the product by virtue of VIX options introduction, and to this day I'm happy to say that VIX options are oftentimes our third, sometimes second most active index product here at CBOE. 2008 was really the bellwether moment because a lot of market participants had that eureka kind of moment when they discovered, after doing all the back testing, that if they had had an allocation to VIX futures, small as it may be, it would help smooth out some of those bumps in the road. VIX, of course, has this inverse correlation to the broader market, but it also has a positive correlation to credit markets. So there were a lot of firms out there who had credit strategies who came to us post-2008 and said if it wasn't for a product like VIX Futures, their fund could or may have blown up. And again, that inverse correlation, I think, was very, very evident during 2008 and the early part of 2009. And that was about the same time that people started to incorporate VIX into a trading strategy, started to accept the idea that, yeah, volatility is an asset class, and it really brought us face to face with a whole new set of market participants. And never was that seen so much as in 2009 with the introduction of VXX, the short-term note that Barclays created. It's a daily rolling exposure to a constant 30-day implied level of volatility. And that was really what jump-started the trade in the VIX futures. And I think at last count, there's probably 5 billion assets under management in the various ETPs out there. And all of those funneled back here to CFE and the VIX futures. Now, some of those products are a little funky, you know, caveat emptor. You have to read the prospectus. Some of the products are quite bespoke, highly structured, offered 2 times leverage, 2 times inverse leverage. So in our mind, at the end of the day, it makes our VIX futures and options look like the cleanest and the easiest of the bunch to use. 2011 saw CBOE really embark on this path where, based on market participant input and reaction, yeah, we signed on to the fact that volatility is here to stay in the form of exchange tradable products. And yeah, it is an asset class at this point. So we have the luxury of owning that methodology to VIX, right? So we can apply it to other asset classes, which we did in 2011 and earlier this year. So now you can trade volatility based off of gold in the form of the GLD ETF. You can trade it in the form of emerging markets based off of the EEM ETF. The same thing for the oil based off of the USO ETF. And what's left? Brazil. So now you have a suite of volatility futures products that offer market participants a chance to diversify that portfolio even further. It offers market participants a chance to explore relative value trades. We've already seen examples of traders putting on a Brazil emerging market type of play, examining, again, a relative value strategy. Right now, emerging markets is probably our second most active VIX product. Going down the road, you will probably see other products of that set come out. We currently calculate VIX index values for Apple, Amazon, Google, Goldman Sachs, and IBM. Whether or not they will see the light of day as tradable futures products, yeah, they will. We'll probably list them in one at a time over a longer period of time so market participants can get used to trading single name volatility, because again, single name volatility is going to act a little bit different to index volatilities. But point being is that we feel that the marketplace has matured enough. We have a good semblance of market participants that can support a variety of volatility products. And again, I think that's pretty well evident when we look at 2012 and just in recent weeks, record levels of open interest, record levels of average daily volume. With 3 days left in the month, I can confidently say we'll probably have another record month here at the exchange. So while other industry products seem to be taking a bit of a hit, and I think we all agree that industry volumes overall are down, volatility remains a pretty good franchise here, and it's through the support of traders coming through Advantage that make it worth our while to introduce these new products and host joint events like this. Why did we extend the trading hours in 2011? It's a global volatility market out there. CBOE has the global benchmark for trading volatility. SPX is certainly the barometer for equities in the world. And when we dig down into our market data and we look at who's trading the product, we still see a fair representation coming from Europe and a little bit beyond. In the early days of the product, it was primarily a lot of the French banks and the hedge funds out of Mayfair and London who were trading the product. But as the popularity and as people managed to wrap their heads around not only on how to trade volatility, but why to trade volatility, it became more of a domestic product. But with all that's going on in Europe, why should we limit market participants who have exposure to ECB action, IMF statements, or contagion in Greece or Spain? to wait for our hours to open. So in 2011, we rolled back the clock. We now allow VIX futures trading at 7 a.m., which also gives you the ability to enter into a position, offset a position ahead of key economic releases like unemployment on a Friday or PPI or CPI. It's been tremendously successful to the extent that early open, just that 7 a.m. to 8:30 time snapshot, accounts for over 5% of our average daily volume. And when we look at it, it's coming from a wide variety of market participants both here and abroad. So that helps jumpstart numbers like our year-to-date average daily volume of 81,000 contracts, which I think is probably closer to 85,000 contracts right now. And do the math, this is a $1,000 contract, so that's more than a significant amount of vega that flows through the VIX futures on any given day. 400,000 in open interest, of course, the sign of a successful and well-received product is certainly going to be in the form of open interest. We've really just keep on setting new benchmarks for ourselves with this, and we're excited with our 24/5 build-out, which is going to occur sometime in the early part, probably by the second quarter of next year. So in addition to placing a hub in London, that will coincide with our introduction of 24/5 trading. It may not be true 24/5 around the clock. We need to make sure that Iqbal and Sherry get some sleep at night. So we'll probably take that early session and start it at 3 a.m. and then as market demand reveals itself, we'll increase that time frame so it is truly 24/5. And again, these are all initiatives that have been brought to us through active traders trading the product. Not a day goes by where we in business development don't get calls about, have you ever thought of this, or could you consider this? So it was things like the early open, it's things like the 24/5 that was catapulted to the front of our priority list through the input of, again, market participants like yourselves. Nice hockey stick chart there, right? So that's what we like to see. That's what the analysts like to see on our corporate reports here at CBOE Holdings. The breadth of participants since that day of OTC variance traders, no doubt has grown. So we're well beyond the point where it's strictly the investment banks. And again, with the $5 billion assets under management from the various exchange-traded products tied to VIX back there, there are a fair amount of groups who are either trading VIX against the various notes, indexing to these various notes, so they need the exposure to VIX futures. And with that additional liquidity and depth of market, that draws and attracts the prop trader groups. Prop trader groups shouldn't really care if it's beans, bonds, or bellies, as long as there's price discovery and movement. And that we have with the VIX futures. And at $50 a tick, you get a tremendous amount of leverage trading VIX futures. CTAs are another area that we are recently getting closer with, working with. Traditionally, the CTAs, through information that they have provided us, prefer products that have a trend-following characteristic like your truer commodities, ags, S&Ps even. And we argued with the CTAs in the early days of the product long and hard to have how we felt that VIX does have a trend in the form of mean reversion. Over the course of the history of the product, VIX does have this tendency to revert back to a mean. I think we call that somewhere in the 22 area historically for VIX. So we would say, well, there's a trend right there. Well, I think after 08, they finally started to listen to us because we're starting to see examples of CTAs who are deploying strategies using VIX futures as maybe a short-term and temporary overlay to kind of smooth out some of those longer-term hits that they may be taking. Hedge funds, without a doubt, they were there from day one. They're not going away. Pensions and endowments are probably an area that we need to embrace and get a little more cozy with. There's a whole vetting process in order for any endowment or any pension to introduce a product to their particular portfolio and trading strategy, and we have to go out and meet with the consultants for the various endowments. But slow but sure, they are starting to view VIX. face it, everyone looks at VIX itself, right? You can't help but trip over it on Bloomberg or on CNBC in the morning. And tip of the cap to them, they do a great job of talking and promoting VIX, but you can't trade VIX, right? The index itself. So the closest proxy for movements capturing volatility will come in the form of certainly front-month VIX futures. So I talked a bit about CTAs and diversifying using VIX as a short-term overlay. Again, the numbers speak to themselves in terms of that 84,000 in average daily volume. Asian Australian-based firms. That's going to be part of our 24/5 build-out. I think Mr. Brodsky, our chairman, has already gone public with a statement that going beyond a London hub, you can fully expect us to expand into the Asian theater, and that would probably involve locating of a hub in Singapore. There's a few amount of firms that are quite active in the product right now that are already setting up shops outside of Chicago, outside of London, and putting them in Singapore or Sydney. And our data mining has already revealed to us that we do have firms and shops in those regions trading our product. So internally, we're quite excited. We really feel that 100,000 average daily volume is certainly within reach, probably within the next calendar year. As the second generation of these ETPs continues to evolve, and yeah, there's been some consolidation in that area of products, but I think, again, it all comes down to the fact that market participants, whether they're insurers, hedgers, traders, scalpers, you name it, have all now embraced the fact that volatility is indeed an asset class. I mean, when you think about it, VIX is, I don't know where we went out today, 15 maybe, let's call it, but we're putting up the type of numbers in volume that we wouldn't see unless volatility were at 30 or 40. So people are finding ways to use VIX to complement and augment their portfolio. And to talk a little bit more about that, my pleasure to introduce Jamie Tyrrell. As I mentioned, Jamie is very instrumental as DPM in the VIX options down here on the floor, as well as market making in mini VIX futures. Yes, we have a mini VIX futures. It is 1/10 the contract size of the big VIX. Word about that. Take a look at it. It's a good product for us to have out there. It's pretty much in lockstep with the big VIX in terms of quoting width. It's probably 20 up at any given time. And it was our response to the retail audience. If you think back on those last few slides, you didn't see any mention of retail. At $1,000 a vol point, again, 50 bucks a tick, it gets kind of, that's a chunky product for a true retail type of trader. But in response to that, we created a mini VIX product. Again, $100 contract, 1/10 the size of the bigger VIX. But timing is everything, right? So about the same time that we introduced mini VIX futures, Barclays came out with the VXX note, which somewhat obviated the need for us to have a mini VIX futures because everyone that has a Schwab or Ameritrade account can trade VXX, and now they're vol traders, right? So we're keeping mini VIX out there. Jamie does a great job of supporting the product and a handful of other products listed here at CBOE. In fact, it was Group 1 Trading that approached us, I think a year after we introduced VIX futures, and in essence said, hey, we've got a model on how to trade and price options. So we sat down, listened long and hard, and they've done a fantastic job of not only pricing, bringing flow and liquidity to the product, but helping us market that product to help us get it to the point that you're all enjoying trading it now. So at that point, I'll turn it over to Jamie. The other one is minimized down in there.
I wanted to start off by talking kind of how the product's trading right now and where we are. So obviously the VIX cash has been very low over the last month and a half, especially when compared to where it's been over the last 5 years. The highest for the VIX cash, I think, was 87 back at the end of 2008. So right now we're in the natural state of the VIX futures curve, which is the state of contango. You can see the front month October at about 17. This is with the VIX cash at about 16 or so. And all the way down to the back month, May and June, up around 25. So Jay talked about mean reversion, and to me, when I think of the mean reversion, I think of where people are pricing the long-term VIX futures. So I'd look at the back months. People are expecting over the long haul right now, the VIX is going to revert to a mean of about 25, 26. And that'll change from month to month and from day to day based on where the VIX itself is trading, and also based on the expectations of where we could be in a year. So recently in early September, there were a lot of news out of Europe, a lot of calming news where we really saw the S&P 500 pop from just under 1,400 to all the way up to 1,450. And we saw on those news events huge move downs out of the back month futures, more so than even the front month. Meaning after that news came out, a little bit of stability out of Europe, people were expecting a lower long-term VIX. Rather than a 28, a 29, they were expecting 25. And to talk about volume, you can see the volume really concentrated in the front month future. The front month and the second month are the two that are involved in the VXX calculation. So you get a lot of ETP paper on those two. But also the front month is the most volatile. It's the one that moves the most. The VIX cash is even more volatile, but we'll see the VIX cash move anywhere from 100 volatility to 150 volatility, really moving day to day at a very high level. And then the October, the front month will move at a volatility a little bit lower than that. And the back month, the June, the May, the April are going to be moving at the lowest volatility because a front week event, a front day event, a bad employment number, although it might really pop the VIX, it's not necessarily going to transform everyone's view of where we're heading in 6 months, where we're heading in a year. It'll be a more near-term impact. So different strategies we've seen employed in the VIX futures. This one points to directional trading. So certainly there's been a fair amount of directional trading. This talks about taking a short-term short position in a VIX future. Well, when I think of a VIX futures curve, I'm thinking about a distribution of possible outcomes. So with the VIX at 14 and 15, even when it's that low, you can see in VIX futures prices and VIX options pricing, nobody's really pricing in a huge possibility of a move lower. You're at the lowest spot you've been in 5 years, and nobody sees a 10 VIX in the next year, year and a half, or an 8 VIX. The VIX isn't a stock. It's not heading to zero. And so when you have the cash at 16, to me that October future being $1, $1.50 higher is just the range of possibilities. You're seeing, yes, there's a chance we stay here at 16, go to 15, go to 14, but there's certainly a possibility, and we've seen it multiple times over the last year, 18 months, where you see the VIX pop up over 30. The debt ceiling, the Japan nuclear situation, both of those had the VIX over 35. And so you're pricing in a bit of risk into that front month that we see an event like that, but more so in the back months. They say, yes, we could stay at 15. I don't see us going to 10. We need to price in the possibility of a VIX 30, 40, 50, because we've seen those explosive upside moves in the last few years. Where do I go? So this talks about the strategy of being short a VIX future, which over the last few years has certainly worked out well. We've seen the S&P 500 move from 700 to 1450. And throughout that time, you've had the implosion in the background. Everyone's seen the VIX go to 90. Everyone who's trading today has seen that. And so that has really influenced the prices of back month futures, of the expectation that this could happen again. So when a trader takes a position in a second, third, fourth month future, they're collecting some of that risk premium of, yes, volatility's been coming in at 14, 15, but we always have that possibility of an explosive pop. So a trader might sell a third month future at 21 right now. And if no event like that comes, the risk premium is going to slowly decay as you approach expiration. You're going to see that future move more towards where the cash is. The risk of that strategy is obviously if an event does come, the VIX can move just explosively to the upside. The short-term high-frequency trading, we see a lot more trading on days that the VIX is really moving. 3-4 years ago, the spreads in the VIX and the liquidity available, maybe 10, 15 cents wide, 10, 15 futures up, didn't really lend themselves to a high-frequency trading point of view. But right now, the front month through the last month, all of those are a single nickel tick wide. And all of those futures, there's a lot of depth there. The front month will commonly be between 200 and 500 up. And so high-frequency traders have gotten more involved in the VIX futures. And the volume that we've seen over the last few years and the increase kind of begets more volume. As people see that you can have a 200 to 500 up market nickel wide, they get more interested. They know that if they take a position, they're going to have price points where they can get out of that. Mean reversion opportunities. We've talked about mean reversion and what that means. How the VIX isn't a stock like Apple that starts at under $100 and slowly moves up and may never come back to where it's traded. The VIX does tend to revert to a long-term mean. And so we'll see different mean reversion trades. One of them that's common would be selling a back month future, so selling a March future and buying a shorter term future, a November future. So the spread between the futures is $5, $6, saying that eventually the trader putting on the position might believe that spread would contract, that the futures would trade closer to each other and at a level that would suggest less of an expectation of an increase in volatility. Generally, you'll see the spreads between the futures contract as the VIX cash raises towards that long-term mean. So right now, if we move towards 25, you would see a lot less contango on the screen. Right now, there's a $9 difference between the first VIX future and the last VIX future. If the VIX were trading 25 right now, I think we'd still see June higher than the front month, but the spread would not be $9. It might be $3, it might be $2, it might be $5, but it'd be a lot tighter. So a mean reversion trade right now would be a bet that the VIX at 15 right now will quickly move towards a long-term mean of somewhere in the mid-20s. Relative value arbitrage approaches. There's definitely a number of people trading the VIX off of other products. Jay and I just talked about how customers are putting on trades of VIX against E-mini futures. Another relative value trade you'll see is VIX against S&P 500 options. So the October VIX future is literally going to settle to the prices dictated of the November S&P 500 options on expiration Wednesday. And so traders might see an opportunity where S&P options are bid high. It looks like the front month future in VIX is offered down and put on a spread of those two. So we definitely see a number of our customer base trading VIX futures against products in other classes. This is a volume chart, just looking at VIX volume as compared to a number of different commodity volumes. And as Jay has pointed out, the volume in VIX, one, has a 1,000 multiplier, and two, has just really been increasing to the point where 81,000 a day isn't the average daily volume we're seeing anymore in August or in September, it's upticking even more than that. The last couple of days we've seen over 100,000, and that's been pretty common. This is a big reason why we see a lot of interest in trading VIX, namely on this chart, the high negative correlation to the E-mini future. And not only is it a high negative correlation, it's also an outsized volatility. So whereas the E-mini has right now about a 15, 16 volatility, the VIX moves much more, 4, 5, 6 times more, so that traders who have the VIX futures to protect themselves against E-mini find that they need a lot less of the VIX in the portfolio just because it moves so heavily and so sharply against the S&Ps.
What is the ratio?
Well, it'll change time to time. But right now, I think we're seeing the front-month VIX future move at about a 90 volatility, and the S&Ps at about a 16. So that's not hard and fast. You could see the S&Ps were down 1% yesterday, so they were down about 12. The front-month VIX future was up $1.25, which was about 7%. But it's not 100% correlation, so it's not you can have a day where the S&P's down 1%, and the market was expecting a bigger move. You know, a lot of times when we had the VIX in the 30s and 40s, we'd have a day where the S&P was down 1% on an employment report, and the market was expecting a 2-3% move either way, and so you'd see S&P down, VIX down, and those days can definitely happen, and that's why you see it has less than 100% negative correlation. So it's hard to make a hard and fast rule on that, but generally it moves right now 4, 5, 6 times in percentage terms more than the S&Ps. This is about trade at settlement futures. Jay and I have both touched on how the exchange-traded products, namely the VXX and others, have really added to the volume and customer base in VIX futures. They're not the only ones who use trade at settlement, which are agreements to enter into a trade at the closing prices. So any sort of ETP who was looking to track the VIX and track the closing prices, they might use this as a way to capture that close, to trade on the close. Other traders might simply want to take off a position at the end of the day, and this locks you into the settlement price plus or minus 10 cents on either side. In VIX futures, if they go out a nickel wide, the settlement is to the offer. And so a lot of times you'll see TAS trades will be trading between either 0 and a nickel under the offer. So they might be 3 cents under at 4 cents under, 3,000-4,000 up. We've seen just a tremendous amount of liquidity in here. I know on Tuesday we traded 120,000 VIX futures. We traded about 12,000 TAS. And in addition to that, just trading in the last minute of the day, probably another 6,000-8,000 futures traded outside of that at the end of the day. So TAS is a tool that has really added to the volume of VIX. It's made it easier for ETPs to track the VIX and capture the settlement price. And Jay, did you want to talk?
Thanks, Jamie.
Yeah, no problem.
Excellent.
Can I ask one question before you go?
Sure.
Does it trade as calendar spreads, or is that just a synthetic thing you do yourself?
For TAS, or?
No, for the VIX futures.
Yeah, they trade as calendar spreads. So the tick size in VIX futures outright is a nickel. In calendar spreads, it'll be a penny. So right now, the front month calendar spread, today it's traded between $1.10 and $1.40, and you'll see bids and offers in the order book for, you know, a 133 bid at 135. You'll see tight markets, and you'll see a lot of the volume goes up as calendar spreads.
Are you guys aware of how TT has it listed backwards on the calendar spreads? Like
I don't use TT with the way I use a different program, but I see it. So I would see it as negative 1.13 at positive 1.15. And that would mean that the second month is trading over the first month.
Because they've got it somehow listed backwards, and when you're supposed to be selling a contract, you're buying it, and they just don't seem to care.
Okay.
They're going to fix it when they update to their...
Is it backwards? Or, I remember when we first started trading calendar spreads, I found it a little counterintuitive, but kind of eventually you figure out how it's listed.
Okay.
But yeah, I'm not sure how TT lists it because I don't see TT. But it can be confusing because you're talking about buying one and selling the other. So are you buying it? Are you selling it? And it doesn't depend on which one's currently over. It depends on which one's further to expire.
Okay.
We are aware of it
Yeah.
at the exchange. And part of the issue is the way TT displays it, that whole ladder system versus the horizontal way that our GUIs are set up. And it all goes back to our spread platform was built from an equity side, being an equity options exchange at the time. And it was always presumed that if you're rolling or spread trading, you're buying the back month, selling the front. So that's how here at the exchange we define the spread. So when September goes off, we add the new month, it will always be selling the front, buying the back, and because of the contango, the price you pay for that back month is going to be more than you collect for the sale of that front month. So that's always going to be displayed as a debit spread in our system. Now, if that spread is October and you want to do it as defined, you click a button that says same or as displayed. TT, I don't think, has managed to figure out the whole other side of that where you'd want to buy the front and sell the back, which we call opposite to as defined. TT is currently in a rewrite phase for CFE, and it is our understanding that they're going to work with some logic that our systems area is going to provide to them to do away with that whole minus sign.
Do they have an estimated time?
We hope it's ready for the first of the year.
Oh, okay.
Right. Do you guys have other platforms that I can mention that I know that have spread functionality that I think it's more street friendly?
At Advantage we offer a number of different...
CQG, I'm told, has recently built out their spread capability expressly for VIX Futures and CFE, and I'm told that's pretty spot on.
If you were to use a spread matrix, say on TT, are the prices that are in the spreads, are they implied in, or are they actually, are they outrights?
The way our spread functionality works is that, first of all, there's no market makers in the spreads. So you could put your order in, and you don't necessarily need to wait for a contra order to come in to trigger it. It will look at the outright legs to trade your spread.
So it implies it?
Yes. And I'm glad we're talking about spreads, and you brought up spreads too, because of that term structure, it's a very popular play, rolling down the curve. But it's really a cost-affordable way to trade the product too, because our margins on spread trading, I think, are almost a tenth of the outright margins if you're just going to trade a single leg. So it's cost-affordable in that regard. And because of things like VXX and the term structure, spread trading accounts for nearly 20% of our average daily volume. So the spread product is quite active. And the same thing with TAS. And TAS was one of those build-outs that came from the input. We have a CFE advisory committee, which is comprised of industry folks, traders, back office people, managers, both here and abroad. And it was TAS. The TAS idea was introduced to us through that vetting committee. And TAS trades are probably, well, as you alluded to, based on last Tuesday's trade, 10% of our average daily volume. So I think that points to the fact that we as an exchange work with our support group, which is the traders of the product, the users of the product, to make it more well-rounded and better received. So I had talked earlier a bit about a few of these other products. NASDAQ 100 volatility may be of interest to you because it falls into that into that index-based category. So that might be a relative value opportunity to look at trading NASDAQ VIX against S&P VIX. In addition, just this year we introduced a slight deviation away from the volatility space in the form of radar logic. RPX has been a metric of the closing prices of residential real estate for quite some time, and together with radar logic we crafted and built a tradable real estate product that a lot of realtors use rather than Case-Shiller, because from our dialogue with the agents out there, because radar logic is built off a square foot metric, it's an input that all realtors and actually home buyers are quite familiar with. The thing about trading RPX, it's more of a buy and hold. So if you are day traders, scalpers, you know, just bear that in mind. It's a great way to get exposure to residential real estate. So we continue to put some effort into marketing that product. Brings us to the end of the presentation. Here's all our contact information. I'm joined by Peter Osborne over here and Jen Fortino over here. We're basically half of the CFE business development staff. Please grab a handout as you exit today. If you have any questions about today's presentation or anything in general about that we didn't cover, that Jamie and I didn't cover during the presentation, we'll be happy to help you guys with those questions. And there's a question.
Do you have like a 5-year profile of the income product you can show us?
5-year profile of the
Data front one.
tick data or closing prices? Oh, sure. Yeah. We can get you that. In fact, I can point you to the website, and it's all out there in Excel. But yeah, just shoot me an email, or I'll give you a business card on the way out, and we can make that available to you.
Do you guys have any plans on listing a exchange-traded butterfly contract along with your spreads?
We allow for that right now. You can do ratio spreads. Yeah, we did build out and tested butterflies. I don't know that anyone's ever traded a futures butterfly, but yeah, it's permissible and it's built into the system.
What about options on VIX? It's currently a security, correct?
Correct.
Is there any chance that there'll be options on futures in the...
We had them. We had them for a while. We had weekly options on VIX Futures. And without a doubt, weekly products have been well received and I think tremendously popular among all the various exchanges that list them. But part of our quandary with building out CFE and getting VIX out into the forefront was, A, not everyone has a futures account. There's not enough advantages out there in the world. It's very easy to talk about VIX options because, again, a lot of people, my mother included, have got, you know, an account at TD Ameritrade or Schwab or any number of them. But the problem that we had with the weekly options on the futures was we felt that people were still getting used and acclimated to VIX. We introduced it more in a more volatile regime at that time. And again, it's just, we didn't, probably the fault fell on us as we didn't market it well enough to the retail client, which we felt would have a lot of interest in a $100 weekly product. So, plus, and you might be able to speak to this too, Jamie, it was starting to get a little busy out there because you got the VIX options, the VIX futures, mini VIX, and now to that we throw a weekly options on the VIX futures that settles into a mini VIX future. So I think people just kind of said, wait a minute, you know, let's just trade these for a while now.
Yeah, just brought up good thing I was about to ask you is the implementing this to the retail clients that are, you know, regular folks having retirement plans, putting volatility in their portfolios. As you said, you have options on it, futures on it, mini futures on it. You know, what just the regular folks can use as far as now there's a XIV reversion of it. Mm-hmm. You know, what's for those folks, or maybe for investment advisors that can use for those folks?
Well, to that I would say
Because they don't have a futures account, you're right, just have a regular brokerage account. So
Right. Well, then they give Jamie a call, and Jamie talks to them about the VIX options.
Okay.
But that's a good question, and a response to that would come in the form of the fact that some of the new products I talked about, the emerging market, the gold, oil, those are all $100 products. So along with Barclays' involvement, they are acting as lead market maker for those products. With that alone, you have the assurity that they're in there providing two-sided markets throughout the day. But their sales efforts had pointed to what they called professional retail, who would be more willing to trade a volatility product for the first time if it were in a $100 multiplier form. So we continue to evaluate the growth and progress. Who knows, over time, we may need to change that. Over the course of history of VIX Futures, we've gone from 10-cent ticks to penny ticks to now nickel ticks. I don't think we've ever changed a multiplier on it, but we will respond to what the marketplace demands. So, but again, I think those Barclays products are pretty interesting to look at. I don't know, I think we talked about this earlier about whether or not Advantage has security futures on the platform at the time. And we recognize that not all FCMs clear or transact security futures. So we have a movement within the exchange here where we're going to petition the regulators to create a volatility bucket. So then that way we could take all of those new products, put them in with NASDAQ VIX, S&P VIX, and just have not a broad-based index category, but a volatility category. And that opens us up to expanding those new products out to everyone, including retail, at $10 a tick.
Yes, that's what I'm saying. So at this point, there's not really like a security VIX where they can be long volatility for the next year or so if they're seeing something like that.
What's the longest dated node out there? Do you know?
For
VIX.
like,
is there a year?
Like
is there a year node out there?
Like VXZ, you're saying? Or?
Yeah.
VXZ or VXX? Or
Yeah, I know VXZ goes out to the 7th month. I'm not sure if there's a further one.
I think someone may have a 1-year implied volatility product out there, but yeah, we'll look into it. We've actually been approached by one of the banks of whether or not we could build out a, rather than the 30-day implied volatility S&P VIX, a 1-year product. But so far we haven't seen anyone step up to make markets on it yet. So.
Right.
With that, I want to thank Jamie and Jay for taking the time today. I thought this was a great presentation, so thanks for your time. Thank you very much.
Welcome.
If you do have any follow-up questions, feel free to contact Jay. His contact information is up there. Or if you have connectivity questions, feel free to contact Advantage Futures. You can talk to your client relationship manager or contact us through our website or phone number. Thanks again for attending today.